Have you ever wondered why some investors seem to always come out on top, regardless of market fluctuations? One key factor is understanding and leveraging the power of consistency. Now, you might be wondering, what does consistency have to do with investing? Well, it's all about the consistency avoidance tendency, a psychological bias that keeps us from changing our beliefs or strategies, even when presented with new, contradicting information. This is one of the 25 tendencies in Charlie Munger's eminent Psychology of Misjudgment. Munger, renowned investor and vice chairman of Berkshire Hathaway, highlights how this tendency can significantly influence our investment decisions. It can make us stick to a failing strategy out of sheer stubbornness, or it can reinforce our commitment to a winning strategy, leading to long-term success. It turns out that this tendency can be both a strength and a weakness when it comes to investing. Take Berkshire Hathaway, for instance, where Charlie Munger served as vice chairman. This company is a prime example of Munger's consistency avoidance tendency in action. Over the years, Berkshire Hathaway has remained steadfast in its investment philosophy even when the market is shaking like a leaf in a windstorm. The company is known for its strategy of buying undervalued companies with solid fundamentals. This may sound simple, but it requires a keen eye for value, a deep understanding of a company's business model, and the courage to stick with the investment for the long haul. Take the case of Coca-Cola, for instance, a company that Berkshire Hathaway invested in during the late 80s. At the time, the beverage giant was undervalued, but Munger and Warren Buffett, Berkshire Hathaway's chairman, saw the company's potential. They recognized Coca-Cola's strong brand, wide moat, and robust cash flows. They bought the shares and held on to them even during periods of market volatility. Today, their Coca-Cola investment is one of their most profitable, demonstrating the power of their consistent, value-oriented approach. Similarly, consider Berkshire Hathaway's investment in American Express. Despite the company facing a significant financial crisis in the 60s, Berkshire Hathaway saw an undervalued company with a solid business model. They invested and held on to the shares, even when many others were selling. Today, American Express is a financial powerhouse and a significant contributor to Berkshire Hathaway's portfolio. These examples illustrate how Berkshire Hathaway's consistent approach to investing has paid off. They don't chase the latest hot stocks or get swayed by market trends. Instead, they stick to their principles, invest in undervalued companies with strong fundamentals, and hold on to their investments for the long term. Despite market volatility, Berkshire Hathaway's consistent approach has proven to be a winning strategy. And it's not just about making money, it's about demonstrating the power of consistency, the importance of sticking to your principles, and the value of long-term thinking in investing. So, what can new investors learn from this? Well, the first piece of advice is to develop a consistent investment strategy. This strategy should align with your risk tolerance and financial goals. It's not about chasing the hottest stocks or trying to time the market. It's about finding a strategy that works for you and sticking with it. The market will fluctuate, and there will always be new information that might tempt you to change course. But remember Charlie Munger's consistency avoidance tendency. If your strategy is sound and you've done your homework, resist the urge to make impulsive decisions based on short-term market movements or the latest financial news. Instead, stay the course. Be consistent. Let your strategy guide your investment decisions, not your emotions or the whims of the market. Always remind yourself that investing is a marathon, not a sprint. Remember, consistency is key in the world of investing. So, what have we learned today? We've delved into the depths of Charlie Munger's psychology of misjudgment, uncovering the concept of consistency avoidance tendency. It's this innate human inclination to remain consistent with past behaviors, often to the detriment of our decision-making. We saw how this tendency can shape the way we invest, sometimes leading us down less than optimal paths. We also ventured into the world of Berkshire Hathaway, where Munger, as vice chairman, applied this understanding to create a robust investment portfolio. By avoiding the trap of consistency, Berkshire Hathaway was able to diversify and adapt, creating a dynamic and resilient investment strategy. Finally, we turned our attention to new investors. We emphasized the importance of recognizing consistency avoidance tendency and using this knowledge to make informed, adaptable decisions. By stepping outside the confines of past behaviors, we can open ourselves to new opportunities and experiences. In the end, understanding and overcoming our psychological biases, like consistency avoidance tendency, can help us make smarter investment decisions.